There are more millionaires than ever because of the 401k. It's no surprise, and this is a fact. As of 2024, there's 500,000 401k accounts that have over $1 million in them. That's more than ever, or one of the most powerful tools. So if you don't believe in the 401k or you think a 401k is a scam, this video is not for you. This video is for pre-retirees that have big 401k accounts that need to know the nuts and bolts on how to navigate this awesome account as they prepare to start living their best retirement. Let's get into it. All right, I'm Thatcher Taylor. I own ProPath Financial. A lot of my clients have these 401ks, and a lot of them have rolled them into IRAs, but they were developed in the 401k and then they roll them into IRAs, which we'll talk about in a second. And so the 6 important points we're going to talk about today are first, the 2025 new numbers. We're going to talk about the match, and I'm going to show you an actual example of how legitimate the match is in your 401k. The traditional versus the Roth, rollover options, choosing the investments and what an investment lineup looks like, and then required minimum distributions. All right, the key numbers for 2025 are first, your elective deferral limit is now $23,500. If you're over the age of 50, you can do a catch up of $7,500. So if you're over the age of 50, you can add in essentially $31,000 from your paycheck or your payroll deduction as an elective deferral into your 401k. If you're between ages 60 and 63, that catch-up actually becomes $11,250. So you can put or defer $34,000 of your income into your 401k. If you have a 403b, you get an additional catch-up. And the most that can go into your 401k through all sources is $70,000. If you're over the age of 50, you get that catch-up, so it's $77,500. And if you are between age 60 and 63, you essentially could put in $81,250. And now you're probably saying, well, Thatcher, you said elected deferral are these numbers, but now there's a bigger number. It's because of all sources. You can put in your elected deferral, any company contributions, and if you have an after-tax bucket, you can add more money to that as well, which is a perfect segue to the employer match. But before we do that, hit the bell so you get notified of all new videos. Make sure to like and subscribe and comment with any questions if you have a 401k, and I'll cover it here in the rest of the video. So let's go over the example of the employer match. Most employers, literally the majority, like 90% of employers, do some sort of match where they're going to put some money in on your behalf. I don't like to call it free money because it's part of your compensation package, but it's pretty easy money. As long as you do your job and you make the contributions on your behalf, they'll make contributions for you as well. Okay, let's understand the match formulas. So you contribute, 90% of employers are going to contribute some sort of match into your retirement plan on your behalf. This is separate than a profit share. Some employers will even put in just a fixed amount into your 401k on your behalf. But let's talk about the match. There's essentially going to be 3 main calculations. And let's just use a very simple example. I know most of you are going to make more money than this, but let's just use this as an example. The first example is a 100% match up to 3% of salary. Now that percentage could be different. The 3% of salary could be different. That's up to the company, but let's just use an example where they're going to name a specific percentage. If your salary is, say, $60,000 and the employer contributes $1 for every dollar you put in up to $1,800, which is 3% of $60,000. You right there will get your $1,800 plus their $1,800. $3,600. Pretty simple. You can check this percentage now in your 401k rules. The second example is a partial match where they're going to do a 50% match up to 6% salary, which again, that could vary, but that's a very common baseline accounting is 50% match up to 6% salary. So if you contribute 6% of your salary, which is $3,600, the employer matches half, which is $1,800. Or there's a tiered match where they'll match 100% on the first 3% and 50% on the next 2%. So for a $60,000 salary, the employer matches $1,800 for the first 3%. Perfect. Then the employer adds an additional $600 for the next 2% for a total match of $2,400, which is a pretty good little breakdown to be able to evaluate which match option your company is using. So bookmark this and come back to it after you take a look at what your 401k provider is doing. So now I'm going to show you the power of the match. The power of the match is unmatched. See what I did there? But let's just say you work for a company from age 37 to age 67. So that's 30 years. And let's say you've increased your salary every single year. You've been a great employee, they increase your salary. I use these salary numbers because these are basically the maximum amounts that could go in since 1993. And let's say you contributed 10% of your salary throughout all of those years. and your company matched 4%. I'm just going to fast forward to the calculations. That means over 30 years, as you can see here in the amount column E here, you've contributed $467,000 to your 401k. With a standard rate of return, which we'll get to, of 7%, we'll talk about investment options in this video too, that brings your amount, $467,000 contributed after 30 years, to $1.4 million. There's another millionaire made. 7% isn't a crazy number. That's not unrealistic with a good investment option. But let's say the company matched 4% of your salary. One of our baseline ideas where they just match up to 4% of your salary, which is extremely common. I see it often. In the first year, 1993, when you're 37, it was 36.96. Then you got boosts all the way up to what it is, 9,000 now. So the company has put in 186,000 on your behalf. That 186,000 became 563,000. Now you have a total amount in your 401k of 1.9 million, and all you've actually put in of your money is 467,000 bucks. Don't tell me that this is a scam. This is real money that I have clients using right now, distributing out to pay their retirement expenses. Hope you're enjoying this, giving you actual evidence and information. Please make sure to like and subscribe. Hit me with any questions you've got so far. So let's move to traditional versus Roth, because now we know all the numbers and what can go into your 401k. Now we know how the match works, but now we need to talk about traditional versus Roth. It's the big question. As you can see this image here, there's a balance between the two. They're literally functionally different. There's the traditional and the Roth, and it comes down to taxes when you're deciding which one to use. Traditional 401k contributions are made pre-tax, reducing your current taxable income. Distributions to retirement are taxed as ordinary income, not only your contributions but your earnings. Withdrawals of contributions and earnings are taxed as long as you wait till after age 59 and a half. And these may be rolled over into traditional IRAs with no tax problems. You can roll it over, no taxes, no penalties, to get it into an IRA in your name if you retire or you leave your employer. The Roth are contributions made after tax. I'll tell you a little bit more about taxable here in just a second. With no effect on current taxable income. Qualified distributions in retirement are not taxed. Withdrawals of contributions and earnings are not taxed as long as you don't break the rules. And Roth 401ks may be rolled over directly to a Roth IRA without any taxes or penalties along the way. So here's what it looks like. Let's say you have a $200,000 salary and you contribute $30,000 if you're over the age of 50. Let's say you contribute $31,000 into your traditional 401k. At that point, you're not paying tax on $200,000. You're paying taxes on $169,000. $31,000 goes in, it grows, just like my spreadsheet showed you, grows with the right investment. Your contribution and those earnings become completely taxable to you at some point in the future. Easy enough. If you go Roth and you contribute $31,000 and your salary is $200,000, $200,000 goes on your tax return. You got to pay taxes or have tax responsibility for the full $200,000. But the $31,000 goes in, it grows, turns into a bunch of money in the future, and all that money can come out completely tax-free. So to answer your question, which one you should use, it's about navigating tax brackets on whether or not you're in a higher tax bracket now or you're going to be in a higher tax bracket later. That's how you answer whether to do traditional or Roth. Point number 4 is rollover options and mistakes. Let me show you. This is the IRS rollover chart. Instead of me just explaining it to you, I'm just going to show you. We're going to go down to this column, qualified plan. You can see this little number 1. Qualified plans include profit sharing, 401k, money purchase, defined benefit plans. You can also roll your Roth 401k, if you have any Roth 401k dollars, into your Roth IRA if you would like. Now, there's nobody telling you you have to roll into an IRA, but if you decide to, which a lot of people do, you can move that money over so you get more control, maybe less 401k fees, and you can distribute the money as you see fit. This chart's very valuable in the event that you have other assets outside of 401ks and you're worried about where you could roll the money over, if you could consolidate, and the answer most likely is yes. All right, I've talked a lot about return and investments, so now's the time where we're going to start to discuss it. All right, this is the investment lineup for a 401k of a current client that I have. You can see the list of underlying investments. Every 401k is going to have a predetermined, a pre-built list of underlying investments within the 401k. Again, the 401ks of scam people are nonsensical. you can earn a substantial amount of money. In theory, you could have a 401k, you could have an IRA, you could have a Roth IRA, you could have a Roth 401k, you could have a taxable brokerage account, you could have a trust brokerage account, you could have all these different account types, because that's how they are, is different account types. And in theory, you could have the exact same S&P 500 ETF in all of them. That's what's interesting about people saying that 401ks are a scam. They're not. They're just a literal tax code of the IRS tax code. Look at all these investments. They got mutual funds. They got index funds. The main difference of those are these expense ratios you can see in this column. The mutual funds are going to cost a little bit more. The index funds are going to cost a lot less. They got a couple bond funds. They got a couple money market funds. And then they got target date funds, which I don't love, but they work in the right situation. Your 401k lineup is going to look similar to this, either with less or more or the same amount. But it's about choosing the right investment to earn that rate of return. If you went this Vanguard Institutional Index, it has averaged in its history almost 10%. And my calculation on that Excel spreadsheet that I showed you before was 7%. It's not unreasonable to believe that you can earn a good rate of return with high quality investments. So don't sleep on the investments, make sure to check on them. And if you need additional help, reach out to people like me and we can. And lastly, we're going to talk about required minimum distributions. When you hit age 73 and you have a traditional 401k, you're going to have to take a portion of that money out. If you want to know how to calculate required minimum distributions, check out this video. This will tell you how to calculate required minimum distributions, but we're not going to dive in too deeply. Just know that if you're going traditional 401k to get the tax deduction now, you're going to have a potential tax bill in the future. Well, not potential. As long as you're living, you're going to have to distribute money at age 73 to pay a portion back to the IRS since they've let you defer it for so long. If you turn age 75 after 2033, then 75 is your new age. So 73 now, but starting in 2033, 75 is the new RMD age. I think I said that kind of funny in the beginning, but you get what I'm saying. In 2033, the new RMD age is 75. There you go. Roth 401ks are very interesting. Just recently, they changed the rule where you do not have to make required minimum distributions out of Roth 401ks. Roth 401ks are a very interesting tool. Tax-free income, tax-free growth, no required minimum distributions, complete flexibility, and it passes your heirs tax-free, and they don't have to distribute and pay taxes. It's a very interesting tool. All right, in closing, go take a minute to go check on your 401k. Log in, because most of you probably don't even know your login, but go log in and check on your 401k. Make sure your beneficiaries are set up. Make sure your investments are set up the way that you want in accordance to your goals, and make sure you have a plan on when and how to distribute your 401k in the event that you retire or you get laid off or you leave your job for a new opportunity. If you need help with all that, you don't really know, that's what I specialize in, is retirement planning. And through this process, we make sure everything you have is functioning in the right fashion. So if you need more personalized help, click the link below, go to propathfinancial.com, get started. You'll meet with me directly, and I cannot wait to chat with you. Please like and subscribe. If you enjoyed this video, give it a thumbs up and even a share to someone you think this might be valuable for. Thanks again for watching. We'll see you next time. Once again, I'm Thatcher Taylor, founder of ProPath Financial and certified financial planner. If you're interested in seeing how we help our clients or implement these strategies that you saw in this video, please go to propathfinancial.com. That's www.propathfinancial.com to learn more, and make sure to say hi to me while you're there. We'll see you next time.